Welcome to BYDFi. I'm Elisa, your guide for this Bitcoin course video series. What does it mean to shorten Bitcoin? Can you profit from Bitcoin even if you think its price will drop? And is it possible to do this without owning any Bitcoin? Well, stick around, because in this episode of Bitcoin Courses, we're diving into these questions and more. Before we get started, don't forget to subscribe to the channel and hit the bell so you'll be notified right away when a new video is posted. Let's get started. Today's focus is on short-selling Bitcoin. Short-selling, often just called shorting, is a way to make money when you expect an asset's value to decrease. It's known as short-selling because you don't own the asset you're trying to sell to make a profit. Please note that neither I nor anyone at BYDFi is a financial advisor, so this video is not intended as financial advice. The goal of this lesson is to explain short-selling as a tool available in various markets, including cryptocurrencies, so you can better understand it. Essentially, shorting works by borrowing an asset like Bitcoin and selling it at its current price. Later, you buy back those Bitcoins to repay the person or company you borrowed from. Ideally, by the time you repurchase those Bitcoins, their value has dropped, so you spend less on the buyback than what you received when you sold them. Let's go through an example. Imagine you short sell 10 Bitcoins when Bitcoin is priced at $10,000. You borrow the 10 Bitcoins and immediately sell them, bringing in $100,000. This transaction leaves you with $100,000 in hand but with a 10 Bitcoin debt. Now, let's say after some time, Bitcoin's price drops to $8,000. You seize the opportunity and repurchase those 10 Bitcoins for $80,000, then return them to the lender. In the end, you've made a $20,000 profit using no initial capital or assets of your own. Hold on. Before you rush to open a trading account, keep in mind that when you short sell, the entity that lent you the Bitcoins can usually demand repayment at any time, often with only short notice. This means you may have to return the Bitcoins before their price has dropped to a favorable level. The more Bitcoin's price falls, the cheaper it is to buy back the 10 Bitcoins, increasing your profit. But what happens if Bitcoin's price rises instead? The maximum profit of a short is limited to the scenario where Bitcoin's price hits zero, meaning you keep all the proceeds since you no longer need money to buy back the Bitcoins. But there's no cap on how much you could lose from shorting. Let's look at that for a moment. Normally, when investing in an asset, your potential losses are limited to the money you used to buy it. Say you put $10,000 into a stock, and that stock loses all its value, your losses are limited to the $10,000 you initially invested. With short selling, however, your losses can far exceed your initial investment, which is especially crucial with a volatile asset like Bitcoin. Let's use another example. Suppose you short sold $10,000 worth of Bitcoin when it was $1,000 per coin. You haven't yet repurchased those Bitcoins, so you still owe the lender those 10 Bitcoins. Now, if Bitcoin's price suddenly jumps to $10,000, which is entirely possible given its volatility, those 10 Bitcoins would now cost you $100,000 to repay. If other traders are in similar short positions, they'll also need to close their positions by buying back the Bitcoins, adding buying pressure to the market, which drives prices even higher. This phenomenon is known as a short squeeze. As you can see, short selling is incredibly risky. If you're new to Bitcoin, or any other asset, you may want to hold off on short selling until you gain some trading experience. Now that you understand short selling, let's look at how it's done. To short Bitcoin, you'll need a trading platform that supports short sell orders. Today, there are several ways to shorten Bitcoin. One popular method is CFD trading. CFD stands for Contract for Difference. Instead of borrowing, selling, and repurchasing Bitcoins, you simply agree to settle on the price difference. With CFDs, you profit from the price drop without dealing with buying or selling. Keep in mind that CFD trading carries a high risk level and is suitable for experienced traders only, as most people trading CFDs end up losing money. If you don't want to use a CFD service, you can short sell Bitcoin on an exchange. Many Bitcoin exchanges catering to crypto traders offer shorting options, and some provide leverage for shorting. Leverage allows you to borrow more money than you've deposited to buy Bitcoins for shorting. For example, if you have $1,000 on the exchange and use a 1-to-3 leverage ratio, you can short up to $3,000, or 3 times your deposit. Leverage is even riskier, because if the market goes against you, the exchange may close your trade early since you're trading with borrowed money. With a 1:3 leverage, any market movement has 3 times the impact. So, if Bitcoin's price goes up by $400, you'd lose $1,200. In other words, leverage amplifies both your gains and losses. If you're at risk of losing more than your initial deposit, the exchange will close your position when you reach that limit, sparing them from needing to recover additional funds from you later. Now, when's a good time to short sell? If you look at Bitcoin price charts, you'll notice a saying that holds true: price takes the stairs up and the elevator down. Uptrends take time to develop, while downtrends tend to be brief and sharp. If you want to try market timing beyond technical analysis, it's helpful to know the Bitcoin landscape. Different events impact Bitcoin's price differently. For instance, Bitcoin bans in China or SEC crackdowns on ICOs also tend to drive Bitcoin's price down. Changes in the Bitcoin development team, like the departure of lead developer Mike Hearn, have also caused price drops. Other examples include the Bitcoin Cash fork and setbacks in anticipated upgrades like SegWit or the Lightning Network. Do these events let us predict Bitcoin's price movements? Not exactly. Events that might logically impact Bitcoin prices don't always have the expected effects. For example, the failure of darknet markets like Silk Road or Alpha Bay had less of an impact than some anticipated. Additionally, media FUD fear, uncertainty, and doubt about Bitcoin has less influence now. With nearly 400 Bitcoin obituaries, fresh reports of Bitcoin's imminent collapse no longer shake the market like they once did. To sum up, short selling, although risky, is common in stock trading and other financial markets, and now, increasingly in crypto. Just make sure to read any regulations or guidelines for covering assets you short sell so you understand what's involved. If you're new to trading, gain experience with regular trades before venturing into complex strategies like shorting. And always avoid investing more than you can afford to lose. That's it for today's episode of Bitcoin Courses. By now, you should have a solid understanding of shorting Bitcoin, a way to profit when Bitcoin's value falls. If you have questions, feel free to leave them in the comments below. If you enjoy the content, please hit the like button and subscribe for updates on new episodes. Thank you for joining me on the Bitcoin Courses of BYDFi. I'm Elisa, and I will see you soon.